is Tuesday, and let me tell you, I don't know why I'm so hyper. I think I've been on 4 cups of coffee already. But not only that, I want to tell you how hard it is to sometimes behind the scenes get a podcast together. And we were running around trying to figure out what was happening to our system that we use for our podcast. But I want to thank Miss Megan. I'm going to introduce you to her. She was super patient behind the scenes. We finally got it together, and we're here to bring you. I wanted to bring a boss woman, boss lady, entrepreneur who's a loan officer with VIP Independent Mortgage in San Antonio and Texas. And I've been using Miss Megan Cloud and her team for, a couple of months now. And I will tell you, it has been a 5-star customer service experience. The people are so great there. And they're starting a movement here in El Paso. And what I really like too, it's a girl too. So, that's why Edgar's not on here today. He's right here on the sidelines.
Yeah.
But let's introduce you. Girl power. Today, Miss Megan Cloud is going to be speaking to us on lending, on what's true and what's false. So go ahead, Megan. The showroom is yours.
Well, thank you so much, Jackie, for allowing me to speak on your podcast. This is honestly the first podcast I've been on. So I'm doing it from my phone since, the lovely technology decided not to work on our laptops, apparently. But thank you so much for the introduction. The pleasure is ours. Seriously, we, just to give you a little background about myself, is I've been in the mortgage industry for close to 13 years. I was one of those silly people that thought you actually had to have a degree to do this. So I have a finance degree. I went to UTSA in San Antonio, Texas, got my finance degree. And believe it or not, a little fun fact about me is that I wanted to be a loan officer when I was, in 3rd grade, which I didn't know it was going to be this. But I did write that down, which is crazy. But I love it. I'm living out my dream right now. I born and raised in San Antonio, but you know what? I love El Paso, Texas. I've been there a couple times, and I really do love the people, the atmosphere. Just you guys are amazing, an amazing group of people out there, and the people of El Paso are just wonderful people. But we're here, started out in San Antonio, Texas, and we're just moving by storm here throughout the whole state of Texas. And, a lot of people call me the mortgage unicorn, and I kind of got that name adopted to me about 4 years ago. Decided to dress up as a unicorn at a real estate function. I wasn't going to go to it because I was kind of just sitting behind the scenes doing loans. And it was during Halloween, and it was when the unicorn came out, and I dressed up as a full-blown unicorn. It was hot as hell in that costume, but nobody knew who I was until I showed up at all the closings. I started taking my unicorn head and showing up at the closings, and that's how I became the mortgage unicorn. Now all of our agents here adopted the actual name, and they did that because we really do go above and beyond here at the Cloud team. We we don't just service like the A+ paper. We really do try our best to try to look at every single client with care. And it doesn't matter if they're wanting to purchase $100,000 home or a $500,000 home or $1 million property. We really treat every client the same. And if the client, we'll dig deep into some of the facts and fictions of this, but just because somebody's credit isn't where it needs to be, or they don't have the 20% down, you know what, that doesn't matter. We will help you get there. And a lot of people don't realize that, in this market right now, like I just pulled up some of the El Paso historical data. And what you may not even realize, Jackie, is that there's about, it says for the first time home purchases, there's 7,386 homes that are going to be taken from the inventory for first-time home buyers, which equivalates to about 63% home ownership rate. 63% of that market is going to be first-time home buyers, and that's huge. So, you guys, the inventory is extremely low. the demand is high, and that just creates bidding wars, and it can cause a lot of people to become fatigued in this market. And we're here to keep people encouraged. It's a long-term game. It's not something that you have to just jump right into. Sometimes you have to plan, and that's what we're here for.
Exactly. And the reason why I keep on getting, of course, I want to educate. I love to educate myself and
Mhm.
the team because, as I always mention, we don't have your expertise behind the scene. We have the expertise in the real estate side, but it is so imperative, important to have that partnership, because as you're educating us, we're educating our clients or the consumers who are going to be those homeowners here in El Paso, Texas. So,
Yes.
there's a lot of truth behind the scenes, and there's a lot of
Hmm.
false negatives behind the scene on why somebody can't qualify for a home, or maybe they're getting so scared at what's happening in today's market that they are
Hmm.
literally sitting on that bench and they do not know how to reach out, who to reach out to, or what's the correct information, what's not. So I wanted to bring you on this special podcast just for the reason being, we're going to talk about some of those truths and some of those fibs, is what I can say.
Hmm. Fibs.
The
Myths,
perfect
fibs.
person to do that with us. And your actually tell us a little bit about your background on, like, how long I know you said it in the beginning, but how are you so thinking outside the box, that type of girl, the one that's knows how to structure a loan, the one that, if this lender says no, they're denied, you can do it. So just give us a little background on how you care for those people as far as like nurtures.
Yes. So, it's funny that when I first got into this mortgage industry, I would, so back then I had a 3-year-old. He's now 16, and, or he's going to be 16 in just a couple of weeks. But I remember pretty much bouncing him on one leg and reading the mortgage guidelines on the other. And still to this day, a lot of people that, get into this industry, they do well for a couple of years or whatever, and then they kind of become jaded. The questions are the same, the questions are redundant. You kind of have to remember, take yourself as a doctor in the mortgage industry. Doctors, exactly what you're dealing with every day, but the consumer or the patient doesn't. And so you have to remind yourself to take a step back and play in elementary with every consumer, that they don't know what they're getting into, and you're the professional. So I remember, reading the guidelines. There's a lot of people that are out partying during that time. It was right during that market crash, the first one. And so I just read the guidelines, and I continue to become, I continue to be a student to the system. And the reason why is, I actually think of it like your accountant, right? Or your tax attorney, or whatever. They all have different guidelines, different rules, that different publications that come out, and it changes the game, right? Some things that we may have not done in the past, we do now, and vice versa. When COVID came out, there was a lot of guidelines that went away. Things that they had to tighten up for a while. And if you're not used to reading those guidelines every day, you can get confused. And the guidelines, there's thousands and thousands of pages of guidelines. It's literally impossible to know everything. But I tell people, I don't know everywhere. I don't know everything. I just know where to go to find it. And I
Correct.
know exactly where to dig into it. And you go, and even if I know the answer, I try to remember to not know the answer. Basically, go look up the answer, because guidelines change, like I said, every single day. Um, FHA, VA, conventional, they all have different guidelines. What goes for conventional may not go for FHA. What goes for FHA may not go for USDA or VA. So every single program has a different set of guidelines. And so that is what has really changed the game for me, is really learning and digging deep into those guidelines. I never want my underwriter to tell me something's qualifiable. I want to be the one to know the rules. I want to be able to educate that client up front. The last thing I want is that client to go under contract, to go spending earnest money, putting option period down, all of that stuff that they do, spending money on appraisals, and then be told they can't buy a house. So one
Absolutely.
of the things that we do set ourselves apart with is what our platinum pre-approval letters. And our platinum pre-approvals, those basically we underwrite the file up front. We gather everything, we verify income, assets, debt, everything up front, so that when they go to shop for a home, they're actually happy, not super scared and nervous. We explain the whole process up front so that they understand, and we really hold their hand the whole way through the process. So really I say just staying focused and really leading from the front. I even though I'm a branch manager and a senior vice president of VIP mortgage as well, I am the loan officer, and I love working with the client up front. I love digging in and getting dirty with that client as far as, the guidelines go, and making sure that they know, they know what they're getting into, and they're making an informed decision and understand. But a lot of time, like, let's dig into the truths and myths here, and let's talk about, I hear this a lot where people say, I think I'm just going to wait and save money, so I have a larger down payment to qualify for a home. Is that might be something on your list to talk
Yeah,
about?
I actually have like 15 questions that some people actually, that's one of them.
Yeah,
So with the craziness of I hate to call it the COVID market, or I don't even know if you
yeah.
want to call it the COVID market. It's post-COVID, but I feel like there's a norm that we're kind of maybe flowing into. There's still a lot of questions that go on our mind as we're, low in inventory and so forth, and putting people into these contracts. I think on the real estate side is we're just like, our minds want to blow up because, those gaps and so forth. So what could we say to the people that are saying, oh my gosh, rates went up, my payment went up, this is not the time for me to buy, I'm going to sit down on the bench for a while, for a season?
Well, and I would tell you that sitting down on the bench for a while actually will cost you money. We don't know exactly where the rates are going to go, and even tomorrow we don't know where the rates are going, but we don't know where they're going to be in 6 months, a year, 5 years. But the truth is, the interest rates are going to fluctuate over time. If rates go down, you can refinance. If rates are going up, at least you're locked in at what today's pricing is. But waiting is going to cost you money in the end. Like, if you just pull the historical data, I mean, here in San Antonio, in 1 year, our prices went up 28%. Like, it was crazy. So somebody that waited last year and wanted to buy this year is paying on average about 28% more for their home than they did the year prior. Your home is going to appreciate in value. Money that you're putting towards the home, that is money that it's like a savings account that you can't touch. It's also got a lot of tax benefits that if you have an accountant, definitely talk to them about the tax benefits on becoming a homeowner. But waiting around is just going to cost you more money in the end. Somebody that waited, 5 years ago is definitely paying a huge penalty for waiting. Yes, rates about 5 years ago were close to about what they are today, actually. So it really wasn't. Things fluctuate over time, and just everything is going to appreciate. We're dealing with huge inflation, and what people don't realize is, if you actually break it down, our income is going up too. If people look at their W-2s and their 1099s in the last 2 years, most of us had an increase in pay. And that's just how it works over time. And really, if you take the increase in pay compared to the inflation, you're really only dealing with a 3% inflation between the average amount of money that people are making between last year and this year, and then the home prices and the appraisal. So yes, the affordability is going away, but the truth is, we all need a roof over our heads. And if you're not going to pay your own mortgage, you're going to pay someone else's mortgage. And in
Absolutely.
10 years, that's going to be the cost of your actual home and rent payments. And the rent payments are going to go up. If anybody thinks rent payments aren't going up, they're sorely mistaken, because investors have to pay more taxes, and that amount is actually going to go onto the consumer or onto the renter. So
So
that is
truth
something.
and false on that really quickly. Is
Yeah,
it cheaper
sure.
to buy a home than to rent a home or an apartment currently?
So truth and false on that. So the truth on this is that it is harder to qualify for rent than it is to buy a house. Most landlords, or if you go to an apartment complex, they like to see usually 2.5 to 3 times your income as far as the rent, the rental payment goes. And really, when you're buying a home, there's a lot of programs out there that you can get into a home for just over two times your monthly income. So as far as FHA loan goes, they can go up to 56.99% debt to income ratios. But, I don't like to talk about the debt to income ratios a lot because number one, it goes over a lot of people's heads, and they don't realize that a lot of the, it, what I calculate in debt to income ratio and what somebody can afford are two different things. That's a very, I feel like that's a family decision. What one person might be able to afford, maybe somebody that has non-taxable income, doesn't have a lot of debt, has no kids, might be able to afford more of a payment than somebody that has a lot of debt, has car payments, it has student
To
loan payments,
travel, likes to spend.
like travel. Yeah, you got to decide what your lifestyle is going to be, what it is that you want in life. So that's it's all different with everybody. But the truth is, it is harder to qualify sometimes to rent than it is to buy. So I always say, hey, the answer is always going to always going to be no if you don't ask, right? So I always tell people, even if you think you can't afford to buy a house, go look. I mean, at least you get your credit pulled. You see, if there's anything negative on there that you need to fix. I will tell you that there's been a lot of times where people thought their credit was great, and we pull, and there's like medical collections on there. Maybe they had some a history of things that they had to get taken care of, and they thought it was off of there. Or maybe they had an old student loan that popped up, and now there's an issue that they need to take care of. And being able to dig deep into your financials and plan ahead is super crucial in this business. It's super crucial in the mortgage field, because you want to be planning ahead and getting started now versus later. Especially if, like, let's say that we deal with people's credit scores that are in the 500s all the time, where they started out in the 500s, and they know they can't buy a house. But we work with them, and we counsel them to get them where they need to be. And the truth is that if you do that and you start sooner rather than later, you're going to save tens of thousands of dollars in interest, because interest rates are tied to they're tied to the program, and they're also tied to the credit scores that you have. So there's lots of factors involved in that. So I talk to people about that as well.
One of the questions, and I'm just gonna like squeeze in there when I hear you going over it, is one of the questions I have is, do I need a 700 credit score to qualify? What are some of the programs that will take the lower credit score? And say we don't qualify right now, we can still know by pooling credit, learning what we have to pay off, and of course, how to bring up our points. So do you need a 700 to qualify? And what can we say to our buyers in that department?
Yeah, so that is false. So that's a myth. You do not need a 700 credit score to qualify. Actually, the truth be told, that it depends on different programs, but VA doesn't even have a credit score requirement. That requirement, yeah, VA doesn't even have a credit score requirement. The requirement is actually through the investors and the servicers. The mortgage company you choose to go with have what they call overlays, and those those overlays are different with every single company, which brings me to a point that, like, if you get turned down from one lender, don't stop. Don't let your dreams be crushed, because there are different guidelines that maybe one lender doesn't know about, or they don't offer that program.
Yes.
But we can go down to 580 on FHA, FHA and VA easily in house. And can you see me? Can you see me? uh, so 620 is really where you want to be able to lock in the best rates possible on those government programs. As you increase that credit score, it actually makes it even better for you. So what we do, and just because you do qualify, let's say we have a client that comes in with a 620 credit score. What we like to do during the process is showing that client in the middle of the process that, hey, what if you just paid down, we do some simulators internally, and it shows us, hey, if you pay down your credit card by $40 here, or you pay off this debt, you can increase your credit score by 70 something points, or it tells us exactly what we need to get to a certain threshold. Now, those thresholds determine what interest rate you're going to get, and it also determines whether or not you go. Let's say that somebody has 20% down, but they have a 620 credit score. Well, FHA might give a better interest rate than conventional at that point. However, if we can get that credit score up to 680, 660, it's going to give them a much better interest rate. Or let's say that they have 5% to put down, and they need more. Obviously, they need mortgage insurance if they put less than 20% down. But if you have a high credit score, or if we can get you to a higher credit score, there are options to be able to do upfront mortgage insurance options, one-time mortgage insurance, to where you pay a one-time fee and then you don't have the monthly mortgage insurance. That's another misconception in the market, is that you have to put 20% down to avoid the monthly MI. So I have a lot of consumers that come to us with great credit, 760, 780, and they think they have to put 20% down to be able to get rid of the monthly MI. And when I show them, hey, the upfront MI, these mortgage insurance companies will give you a really good deal to get rid of that mortgage insurance over the life of the loan, or until they reach the 80% mark. They're actually blown away that they can keep the majority of their money in their pocket, and not have to put that 20% down, when they can put 6% instead of 20%.
So one of the questions I have here is, you do not need 20% down to purchase
Jackie, hold on just a second. I can't hear you. All of a sudden, I can't hear you. Give me just a minute, okay? Hold on.
I'm going to be like Verizon. Can you hear me now? Can you hear me now? Ask questions, guys. Ask questions.
Yeah, it's a very good feedback that she's sharing there in terms of like the 20% down payment. 'Cause I think that's come up very big now, especially with today's market. The rates, remember, we're still on. I think it's good that she's breaking that down for the viewers, for those again that are in question.
Yeah, so I would really, really suggest answer anything you guys wish, because there's a lot of misconception on what you can do and what you can't do. And as a home buyer, you may be sitting on the other side of the live video and say, gosh, well, how do I know if I qualify or I don't? And I honestly think that, if you don't try, you won't know, is what I always say to my buyers, is if you don't try, you will never know. And I like to, I always like to say to my clients that think they have bad credit, or they owe too much, or whatever the case is. And I say, gosh, I'm not here to close you in 30, 35 days. So that's a great thing you have with me and Edgar, is we're here to guide you and lead you, even if it takes a year, even if it takes 6 months. But because we at least have opened up a plan by pulling credit, and Megan doing your debts and telling you what you can work on this year on paying this down or that down, or raise the points, or maybe you're just fine and you're ready. Now, somebody could be ready though, Megan, in FICO score, or say they qualify, but they don't have the funds. What can you help us with misconceptions? One that I have here is funds and gifts. How can we ask mom, dad, uncle, aunt to help us with the down payment? Is that allowed? Where can we get these gifts?
That is allowed. You can absolutely get a gift. You can pull from your 401k. Honestly, a lot of people think that if they pull from their 401k, it's going to be a penalty. But if you read some of the fine print or you contact the 401k company, there is what they call hardship withdrawals. And a hardship withdrawal, people automatically associate with, oh my gosh, a death in the family, something like really bad going on. But part of the hardship withdrawal is also for your purchase of your primary residence. So I encourage, if people are, putting into their 401k, they have that 401k money sitting there, and they just need the option. Definitely look into how much you can take out on your 401k, and it's not a penalty like you think. But honestly, when you're talking to mom, brother, grandma, I say, hey, you know what? If you don't ask, the answer is always no, and a closed mouth does not get fed. But really, you could talk to grandma, and I'm sure grandma needs her yard cuts, or hey, there's some side jobs that people can do. I see people doing Uber and Lyft, and they do Uber Eats and some other cool little side gigs that they can do. I mean, it doesn't necessarily even have to be a gift, as long as you can document and source where the funds are coming from. You can do other things, or let's say that people have some stuff sitting around the house that they want to sell. As long as you can get a bill of sale and you sell that stuff, you sell it online. There is so many ways to make money in the United States of America these days, that, as long as you make a plan, you can execute it. It just, where there's a will, there's a way. And that's how I feel about it.
There's no excuse nowadays to
There isn't. There is not.
If there's video and social media and so forth. So here's another fib. You can only have one conventional loan.
Really?
How many conventional loans can you have? I guess investor wise, right? Or would that be investor wise, or how many properties?
Yeah, so it's okay. Yes. So within most companies, most mortgage companies, certain investors, or certain mortgage companies, they usually like to see no more than 10 financed properties. Now, there's some people that are investors that they go and they pay off their homes and that sort of thing. And a lot of misconceptions out there that states that you can only have 10 homes. That's not the case. It's 10 financed properties. In some ways you can get around that is, right now I see a lot of people right now where their homes have appreciated substantially, right? And so they're taking cash out of their homes to make investments, or they can combine, basically if they can, take cash out of one home to pay off another, to make it, to, open up that stream there. But there's also expanded guidelines and expanded programs, some, what they call non-QM, type of programs out there where they will allow more than the 10. So you just got to ask around. There's lots of, there's all kinds of financing out there, not just, the normal conventional Fannie Mae, Freddie Mac guidelines. There's other guidelines out there. There's portfolio loans out there. The interest rates might be a little bit higher, but you know what? When you have something in front of you and you have an opportunity, sometimes you just got to take the risk and then figure it out later. Sometimes. So,
did you hear that? Did you hear that?
Yes, I did.
The risk. You just gotta take the risk.
Take the risk. Take the risk. The risk takers are always the ones that win. The risk takers are the ones that win. So
I just said, who cares? If we fail, then we fail and we learn from it, right?
You learn, yeah.
But anyways, okay, good for that. And say for instance, someone doesn't qualify it at that very moment. Can they have a cosigner, and how many cosigners can they actually have on the loan?
They can have a cosigner. I think the application probably allows up to 10, but you know, I think I've done 5, I think total. But yes, you can have cosigners. Actually, that's becoming very popular these days. Where you know it's getting very expensive, you know, to own a home, and I see a lot of times where you know they're going back to the old days where 2 families or 3 families are getting together and purchasing home together. They you know get a 5-bedroom home and it's 2 small families. So there's you know there's all kinds of ways to make things work. But yeah, you're going to see a lot of that. You're going to see a whole lot of that as the taxes come out with different counties and the you know the mortgage interest rates rise and their payments rise and people start getting those adjustments. They're going to have to rearrange their lifestyles a bit. And, you know, everything is going up in price. So yes, but you can absolutely have cosigners. And the difference is there's co-borrowers and cosigners, and they're not the same thing. So, you know, co-borrowers are on both the deed and the note, where the note is the mortgage, right? So you can have a cosigner where they're on the mortgage, but they don't have ownership interest to the property. So, you know, let's say that you have, you know, you have a mom that you really don't want them to, or, you know, brother, you don't want them to have the ownership interest. You just want them to have the liability. Or let's say that, you know, you agreed your soon to be ex decides that you're going to co-sign you.
Yeah, like we've had
Hey, be careful in the state of Texas. We're community property. You got to make sure that stuff is in writing.
That's for sure. Texas don't play around, but that's
Texas
fun.
doesn't play around. That is one thing you got to make sure. If you're legally married in the state of Texas, you got to get you got to make sure that your spouse knows about this, because if they don't, they will find out, and we will find out. And it will not be pretty in the end.
Yeah, I've had some cases like that, like, hey, we're gonna sign for a house. Okay.
Yeah, there's a lot of places, a lot of people that are going through hard situations, you know, these days. And let's say that they're getting a divorce, and you know, if you're in the middle of a divorce and you're gonna do a government loan, the guideline requires us to pull the credit of the non-purchasing spouse and use their debts to qualify. So, you know, sometimes it's worth just holding off or waiting until you got all of that stuff taken care of. So
that's a good one. So how about myth or fact? You can only have one FHA loan and be a first-time home buyer within the past 3 years.
So, okay, that's 2 different questions. So FHA, it is a fact that you are considered a first-time home buyer if you have not owned a property in the last 3 years. And how most lenders would actually verify that is through your tax returns. If you have mortgage interest on your tax returns in the last 3 years, then that would indicate that you've been a homeowner in the last 3 years. Or even if you've been inherited a property, or you own a property free and clear, that's still considered home ownership. So, you know, that's another thing, just because you don't have mortgage interest. But if you have no mortgages and you have no interest in any property in the last 3 years, then you are considered a first-time home buyer. I have a lot of people that call and say, no, I'm not a first-time home buyer. I owned a home in 2005, but I sold it. Well, you are considered a first-time home buyer. And there are programs out there for first-time home buyers. For instance, on conventional, you can put 3% down on a conventional loan instead of 5% down if you are a first-time home buyer. You do not need to be a first-time home buyer to qualify for FHA. FHA requires a 3.5% fixed, or 3.5%. I said fixed, like it's a 3.5% APR. Yeah, 3.5% down. And you do not need to be a first-time home buyer for that. Now, it is half truth, half myth that you can only have one FHA loan. So really, there's guidelines and stipulations on that. So let's say that you have a borrower that is moving from San Antonio to El Paso, and they had an FHA loan, and they have, 30-40% equity in their home. They're renting it out, and they're relocating for their job. They got a job in El Paso. Well, you can qualify for another FHA loan. If the property is more than 100 miles away and you have at least 25% equity in that property, of which you would get through an appraisal, and you can show proof of the rent. There are stipulations in the guidelines for this. So that is one way. There's another option is, family size. Let's say that you bought a home several years ago, you had no children, and now you have 3 children, and you were in a 2-bedroom, 1-bath, and now you're moving up to a 4-bedroom, 2-bath. You can get approval from FHA to do another FHA loan. So there are lots of there are different exclusions to that rule. So but if you're getting an FHA loan, and if you have an FHA loan and you're just moving across town and you just bought that FHA loan just 2 years ago, you would not be able to qualify for another FHA loan. You would have to probably go ahead and refinance that FHA loan into a conventional loan, and then qualify for another FHA loan if that's something that you can do, or go for conventional.
Got you. Okay. The next question that I do have is DPA's, down payment assistance, myth or fact that those have gone away or the money has run out? I hear that it's like grant and payback. What can you tell us a little bit about that?
So, the market the market being as volatile as it is, it's really hard to gauge if it's going to be coming back or not. We do tell people all the time, hey, these programs are here one day and gone the next. It's not necessarily that money has run dry. It's just that the market is so volatile that they can't gauge. And it is, a lot of those programs are nonprofits. There's city programs. There are still city programs available. There's different city programs available. All of those guidelines are very different between the different programs. I am a top lender for TDHCA, which is Texas Department of Housing and Community Affairs, and TSHAC. So the TSHAC programs and the TDHCA programs right now, if you went to their website, a little tidbit on this is that it is public information, public knowledge. You can see the interest rates on there every day. You can see the guidelines. You can see the income limits, the purchase price limit restrictions. You can read all the guidelines. You can see everything that a lender sees. And if you go there today, you will see the majority of those interest rate options are now showing an A, not applicable. So I will say that it changes all the time. I've been in this industry long enough to see that it has gone away and come back. So we'll have to, only time will tell on that. But we do have several programs available now. There is still a couple of programs available within those programs, and it's usually the targeted areas. They're very, very specific areas. They have excellent interest rates right now, but they're extremely specific. And so you have to go in there and see, where the targeted area is, and see if that house qualifies. But we'll see if they come back. I even say, even if they're here, I also talk to the consumer about how, sometimes it's not always beneficial to go with the down payment assistance. With what was it last week? The rates were 6.125% for only 3% down payment assistance. I'm sure if you went to grandma or grandpa, they would probably be willing to give you a gift instead of give you a gift instead of, you tell grandma and grandpa, oh my gosh, I'll have to pay this much interest if I go this route. I mean, they love their grandparents. Their grandparents love their granddaughters, and so
be surprised
yes,
where it could come from if you just ask, right?
Yes, just ask, or just save. It doesn't take that long to save 3.5% down if you're not going out to eat every day and buying certain things at the things that we don't need, right? Sometimes
say, and I think
sometimes we go a little and splurge a little on the weekends, don't we? So
I think since we've been busy showing and we've been a little bit, out there, we've been spending on outside, like eating out. And sometimes it's just like you can't control it. But if we were
so
to just
expensive.
save that, exactly, then we'd have a couple extra $100 in our pockets for the week, and that could be used for your mortgage, guys. So
Yeah, I mean, $100 a week is $5,200, savings in just 1 year, and 1 year goes by fast.
like
So,
this. So that's why I say a year goes by quick. So if you don't qualify now, you'll qualify within the year, and that's a great thing to know. What other questions do we have, Edgar? Because I know we had a bit.
Yeah, we had. I mean, you guys have.
We've
really
nailed
cool that
it.
she's answered like 3 or 4.
You've already answered all my
It's
questions.
pretty cool.
you know what? I will point out there's a lot of people that have had, trying times during COVID. I want to go over a couple of different things like self-employed buyers.
Yes.
Now is a great time, especially during tax season. A lot of those self-employed buyers, they'll file an extension. Now is a great time to not only get with your tax attorney or your tax accountant, but as well as get with a mortgage loan officer to see what you would have to, just see what you would have to qualify for, see what your finances look like, to see, for your dream home or your, next home or your first home. It depending on how long you've been in business, there's lots of different guidelines out there. Typically, you need to be in business for at least 2 years, get a 2-year average. If you have been in business for, let's say that you had a business for over 5 years and it was doing really well, and then in 2020 the market hit, COVID hit, and it just, obviously everyone's business really suffered in 2020, and some in 2021, but a lot of the businesses picked back up in 2021. And so a lot of people had a tough year in 2020, had a better year in 2021. And if they're going with conventional, there are guidelines like Freddie Mac will allow you to do a 1-year average on your income. There's other programs out there. Let's say that, you just had a tough year again, and you have a lot of income coming in, bank statements. There's bank statement loans out there. There's lots of different programs out there. Let's say that you had a foreclosure 4 years ago, or short sale, or you were late on your mortgage payments and you got behind, and, you just need to downsize, but you had, a couple late payments last year. Don't let those things stop you from talking to a professional, because you'd be surprised how lenient a lot of the guidelines are. And just on Freddie Mac and Fannie Mae and Ginnie Mae, which is FHA. And like even on FHA, you can have, a foreclosure. You can have a foreclosure in just 3 years ago and still qualify to buy a home. And really, 1 year with extenuating circumstances, it requires manual underwrite. But don't think that just because somebody told you that they got denied for a home or that they can't qualify, don't let someone that isn't doing it talk you out of your own dreams. So that's what I have to say is just, everyone's situation is different. We're all on a different journey. And the choice is obviously up to ours on whether or not we're going to move forward. And really, we live on this land. You might as well own a piece of it.
There you go. I love that. Yeah, you live on this land. You might as well own a piece of it. And I just, I have to piggyback off of what Megan is saying is, I feel that a piece of real estate is going to take you a long ways. So just by owning a little piece. So, man, that's a lot of good information, honestly.
Hey, you know what? If you can own a piece. Yes. Can you hear me?
Yeah.
Can you hear me?
Yeah. I'm like, did you get a call?
Every time somebody calls my phone, I'm surprised my phone hasn't gone on. I should have put it on do not disturb. But every time somebody calls my phone, I can no longer hear you.
We're all
so hold on just a second, and let me see if I can. If you just give me just 1 minute, I'm going to log right back in so I can hear you.
Hey guys. Okay. So a lot of good
Wow, a lot of good
information.
stuff.
Yeah.
Yes.
So one of the best things that I guess that we can really go over is you do not need a 700 to qualify FICO score. That means your credit score. In life, man, we live by a system that tells us how responsible we are and how we're not. I mean, one tidbit that I can say is download your Credit Karma app. It's not 100%, but I love this app just because it kind of gives me an idea and notification of when I've hit a certain percentage on my credit card. Private chat. It says there's a message on private chat. Or, what my credit score looks like. She says she's back. We're letting her in. Okay, we're letting me in. So things like that, but it's just a little quick indicator on how you can fast track or maybe just keep a close eye. I was talking about Credit Karma.
Okay.
I know it's not 100%, but at least it gives you an idea of what is on your credit. It's always
You know what? Speaking of things that's on your credit, there's a lot of people that don't realize, yes, medical bills, people think that, medical bills don't hurt them or whatever, but medical bills can seriously affect your credit score. They don't hurt you as far as qualifying, as far as being able to qualify to buy a home with the derogatory on your credit. But you know what? Getting those things taken care of and removed from your credit is going to be a substantial increase to your credit score.
And that is true. One time I was refinancing a couple years ago, and they called me and told me that I got a hit on my credit, and I'm like, what? Like I literally tried to take care of my credit like gold, and I look, and it's my doctor who took me to collections for $70.
Yes, and people, yes, and $70. I literally just had somebody. I literally
$70. Did you even try to call me or send me a letter that I owe $70? And I remember that I had to pay it and send a letter and take it off my credit. But
it's wild, and really it doesn't take that long to dispute those things. You go directly to the bureaus, TransUnion, Equifax, Experian, and it's very, very fast and simple. And if you don't understand it, we can help you on that as well. But we literally just helped somebody with an $85 medical collection. He was able to get it removed from his credit. It increased his credit score almost 100 points.
Yes.
He was able to save almost $13,000 just in mortgage insurance because he was able to get not only a better interest rate, pay less money down, and not have to do the monthly mortgage insurance. We increased his credit over a 760. So his credit was in the 600s over one medical bill. And removing it, it's great. So, there's so many different things. We could sit here and talk all day about different mortgage and real estate topics, but
there's so many more. Yeah. So I guess at the end of the day, how we'll conclude this is the best way is get with me, get with Megan as far as a professional advice. You always want a loan officer that has that experience behind them. No, I mean, it is what it is. I'd rather work with a loan officer out, or try something different or rescore, whatever it is, So it is important to try to work with somebody that is going to see the potential in you, nurture you, and help you get from A to Z. So one of my clients that you guys do have is a relative of mine, and they're going through I think they should be ready already. They were only given 3 months. So if you see that they're not qualified at that very moment, what is your resource to do for the client to gain that, those points?
Are you talking about after they have tried their best to get there and whatnot?
Yes, like this certain class.
So we have we have what we call internal simulators, internal rescores. There's sometimes, oftentimes, where they have fixed their credit, or they've paid off a debt or collection, and it may just not be posted onto their credit with the credit bureau. And sometimes, if they're doing it on their own, it can take 45, 60, 90 days to be able, and sometimes it doesn't ever come off unless you're actually personally going in there and disputing things. But if you have, definitely, if you're paying off a debt or paying off a collection, you want to, before you actually make those payments, you want to call the creditor, and you want to make sure that you get something in writing that states that they're going to give you something to remove this debt from your credit. And show the balance paid in full, and we can take that letter from the creditor and send it into the bureau on what they call a rapid rescore. It's something that we do in house. You can't it's not legally allowed to be charged to the consumer, and it's a cost to the lender through the bureaus. And you send it in, and it takes about 3 to 5 days, business days, and they will correct the credit report then and rescore that consumer right then. So there is a rapid rescore option available.
Yes, I think that's what they did with when that happened. Yeah. So always remember,
there's lots of options.
There's lots of options on qualifying, and hey, that's a dream come true. So you might as well work on it. Everybody should own a home. It should, if you don't have one yet, it should be on your vision board. And what better way is to sit down with two professionals and get that started. So
what? It does not cost a thing to check your options. With us, we do not charge origination fees. We waive our processing fee and underwriting fee for all veterans, but we do not charge up front. Like, to pull your credit and have a conversation, it is totally complimentary. And I totally recommend that people check their options out. It doesn't cost a thing to talk to a professional, mortgage professional, to get to where you want to be. Even if you're looking 3 years down the line, you want to make sure that you put pen to paper and you write your goals down. And for me, we create a vision board at our office every single year. And you know what? If it's like my coach always says, if it's not written down, it doesn't exist.
Woo! I love that. That's kind of a mantra of, it's not written down, it doesn't exist. But Megan, you literally gave us so much knowledge today. We're so grateful, not only us, but to the audience out there. We want to thank everybody for hanging on to us. We had some technical difficulties, but we got it done. So that's the most important thing. And if you ever need that complimentary, just to know and peace of mind of where you need to be, please contact me to get in through with Miss Megan Cloud, or I'll provide Megan Cloud's here information with VIP Independent Mortgage. She is in San Antonio, but the crew is in El Paso also, right? We're in
Yes. We have an El Paso address. We're in downtown Spaces in El Paso. And we have a local phone number there as well. I actually go out there. I try to make frequent trips out there as well. But the truth is, you know what? People don't even come into my office here in my own city. Most of our stuff is done online. You know what? Just act like I'm right there in your corner. We're right there. It's funny. We live right next door to some of our family members and our best friends, and we don't even see them. It's crazy. So
I live across the street
online world. It's all online.
She lives right across the street from me and my nieces. I never see her, and my mom.
Exactly. So I tell people, yes, brick and mortar, it's great, but it's the future is online. Our brokerages are online now. Everything's online, and so our online portal is absolutely phenomenal. It's super user friendly. We're 100% paperless. So you can just visit us at www.cloudteamhomeloans.com. You can Google my name; it should pop up as well. You can visit us on Facebook as well. It's it's / the Cloud Team. So definitely visit us. We're happy to assist you. And Edgar, we are so excited to watch you guys grow with Real. We are super excited.
Yeah, thank you so much for that. I'm really excited too. There's some agents that just joined us again, and I'm just like, wanting to grow, wanting to see it. So I'm excited.
Yeah, it's great. It's so
Yeah.
great. And you know what? I will tell you that you guys are like I'm the mortgage unicorn. You guys are like the real estate unicorns in El Paso, Texas. I go down. I go down. I don't even know the name of y'all's highways over there, but I'm driving on the highway and I'm like, oh, there they are. There they are, all over the side of the road. So you go ahead with your bad self there.
We're gonna make a statement this year. But thank you. Thank you guys for being in our corner, Megan. We really appreciate you taking time with us. Us as real estates, we're gonna go hit the ground running now with put on our tennies and go show some homes to these wonderful homeowners.
And you know what? I will tell you, right before we leave that, the market is extremely hot. Like I said, the demand is high. The supply is extremely low. There's a lot of people that are going in over asking price, that sort of thing. And so we have a great tool in house that we use where we can basically illustrate what the break-even point is if you end up going in over asking price and you have to pay more than what the asking price is. We can illustrate that break-even point with you, and typically it's a lot shorter than you think. I've been doing a lot of break-even illustrations for a lot of people in the last couple of days, and I'm seeing 15 months, 12 months, 6 months. It's really quite interesting to look at when you're looking at the appreciation over a 5-year term, or a 5-year appreciation time frame. You'd be surprised. So don't let the market, scare you out of just making a move. You'll be shocked at what your home value is in just the next 5 years.
Exactly. Boom diggity right there.
Boom diggity.
Increase. Thank you, Megan, so much.
You're welcome. Thank you so much for having me.
Absolutely. We'll talk to you soon.
Right.
Bye.
Bye-bye.
Bye, El Paso. Okay.
You're still out.